There is a lot of information floating around about option markets, whether they benefit or harm your portfolio. With Harvest being one of the largest option strategists in Canada, I would like to take this time to shine some light on the use of option contracts, what we believe, and how options have been used to benefit portfolios. Options have been around for centuries in many different forms. There are records of options being used in ancient Greece to predict olive crops and the olive presses that would be required for harvest time. Over-the-counter options on companies and commodities have been used in European and early American markets since the 1600s. This type of financial contract is not new to our society. In 1973, the U.S. formally established the Chicago Board Options Exchange, the CBOE, to standardize forms of trade and a clearinghouse for these contracts. Today, the U.S. option market trades tens of millions of contracts daily, with the average daily notional value of traded single stock options exceeding that of stocks at over $450 billion. Currently, the total matched volume across all U.S. option exchanges reaches over 68 million contracts daily, demonstrating the massive scale of options trading. Options are nothing novel to financial markets. There are numerous trading strategies for option specialists. However, there are three key trading strategies that options can be used for. Number one, speculation. Betting the price of a security will rise or fall by putting up a fraction of the amount of that stock value through a call or a put option. Number two, risk mitigation. Institutions and large investors may want to offset some of the risk on a large position by buying a put or selling a call at a time when they feel markets are expensive. Sometimes they will buy a put on an index like the S&P 500 or the NASDAQ to offset a large diversified equity position. This is often referred to as managing downside risk. And three, to generate income. This is what we do. We take a portion of the portfolio, usually not more than 33%, and we'll sell call options to generate additional cash flow. Selling call options on a portfolio is not a perfect science. Strategies to develop selling call options on stock portfolios, also known as selling covered calls, were developed over the last number of decades using both theoretical and practical models. Today, we have both passive and active strategies around selling call options. At Harvest, we believe that additional value can be added by using active strategies in the face of continuous volatility in markets. The option market exists for a reason. Institutions, pension funds, and professional investors use it every day to manage risk, generate income, and shape outcomes. It's one of the largest and most liquid markets in the world. Yes, there is a trade-off. You give up some upside potential, but for many investors, stability and cash flow are the priority. That is where covered call options can be beneficial. Dismissing them entirely ignores why the option market is so big and why so many investors use these strategies. It's not about beating the market, it's about investor goals. Why have covered call ETFs grown so much? It helps to provide cash flow for those pursuing income generation. The option markets isn't built on theory. It is built on trillions of dollars of real investor behavior. At Harvest, we have been using covered call option strategies for income generation since 2013. That's more than a decade of providing income solutions to investors. Harvest ETFs. Income happens here.